Practical accounting, the better way to learn.
So can we talk about the 10 basic transactions? That's pretty cool. I want to get into it. There's only 10, so this ought to be quick.
Why do we care, John?
Because there's only 10.
Well, yeah, but also 10 basic transactions. If you understand the 10 basic transactions,
you can do this course.
You can do this course.
That's what we say.
Yep.
So tell us about it.
Okay. And they're in English.
Oh, wow. That's cool.
10 basic transactions are, and again, we're in the practical T format: assets plus dividends plus expenses equals revenue plus contributed capital plus liability. They're all lined up. First one is buy. Buy, you get an asset, and typically in business, you get a bill and you record that as an accounts payable, which is a liability. A liability, remember, is a debt, and we're going to record all of our debts. Then later on, you pay. When you pay, your accounts payable goes away, and it's minus, and your cash goes down. The third one is use. Use is what we did with Hot Dogs or Us when we, well, actually we did buy and pay, and then we did use in the third one, where we reduced the value of our inventory, our hot dogs and buns, and moved it to an expense. Another way to think about a use is a bottle of water. Suppose you own this, your business owned this bottle of water, and during the course of the day,
That must be good.
during the course of the day, you drank that much, okay? This much is now an expense. What remains is still an asset. The fourth of the 10 basic transactions is make. Make is when you create inventory. It's really a form of buy, but it's a little more complex. We're going to cover make in the next course, managerial accounting. This is called cost accounting. The next one is sell. We did this one in Hot Dogs or Us, only we collected right away. Sell is when you make a sale, and just like above, typically you give a bill. Now, if you get cash right away, then later on you collect. But if you get cash right away, this is what we call a combo. We'll be talking about this a little later. But you can do these two together and you get your cash right away. Collect is number 6. Collect is my personal favorite because revenue is nice. It makes profit, but collect is when your cash goes up as a result of the sale. The next one is borrow. Borrow is done because you need cash. Again, it's one way you get cash. We can get it from selling. We can get it by liabilities. Only we're typically going to sign a promissory note with the bank or whoever the creditor is. So we'll have a different account called notes payable and get cash. On the other hand, if we are the bank, our cash is going to go down and notes receivable are going to go up. Number 9 is the final way that we can get funding is by selling ownership in the company, and we're going to have investors. The accounts are, there's really actually 4 of them: common and preferred stock and additional paid-in capital. Don't worry too much about that. Just call it contributed capital for now. We'll deal with that later. And then finally, here's our thank you, Aunt Betty. When we reduce our retained earnings, which is revenue minus expenses minus dividends, we're going to take that out and we're going to set it up as a dividends payable, which we're going to pay at a later time. That's the 10 basic transactions of accounting. You can get this Excel workbook and a whole lot more
Stuff for free at practicalaccounting.com.
See you there.